In today's video, we are going to talk about when an entity is required to adjust its financial statements for events occurring after the reporting period. IAS 10 only deals with subsequent events that occur before the date of authorization. So for example, if your financial year end is at the 31st of December and directors signed off all the financial reports 3 months later, in March, after all the closing works are done, audits are finalized. However, in April, a month later, a lawsuit settles. In this case, IAS 10 does not apply and the event will be recognized in the next financial reporting period. So we have two different types of events. Some require adjustments and some don't. Adjusting events are those that provide further evidence for events that already existed at the end of the reporting period. So if a lawsuit had already been ongoing during the reporting period, that means it's an existing situation. And let's say a ruling comes along, meaning additional information is provided after the reporting period, but before the date of authorization. That's an adjusting event. Or if you discover that the financial statements are incorrect due to fraud or errors, that's also an adjusting event because it links to events that already happened. Then what's a non-adjusting event? There are events that didn't exist at the end of the reporting period, so it's brand new information that we weren't aware of. For instance, if your investments decline in market value after year end, because the figures as at year end are correct and it wasn't an estimation. So if you recorded that the share price was $50 and it dropped down to $30 after year end, the decline reflects an event that came about after the reporting period. Or if a business disposes of a subsidiary after the reporting period, that's also a non-adjusting event. In order to distinguish between the two types of events, here's a simple flowchart. Did the event occur after the reporting period? If the answer is yes, did the event occur before the authorization of the financial statement? If the answer is also yes, did it reflect conditions existing at the end of the reporting period? If the answer is no, it's a non-adjusting event. If the answer is yes, then it's an adjusting event. Now we'll move on to another flowchart that shows you what to do after you determine which type of event it is. If it's an adjusting event, we have to post a journal entry to adjust the amounts recognized in the financial statements, the profit and loss, other comprehensive income, or the balance sheet. And if it's a non-adjusting event, then you have to ask the question, is it material? Is it significant? Will it impact on the user's decisions? And that's subjective. For a small business, an error of $10,000 may be material, but for $1 million company, that might be seen as something that's clearly trivial, not material. If it's material, for example, a huge decline in market value, we still have to disclose it in the notes, so users still get the information, but it won't be adjusted in the income statement or balance sheet. So you have to disclose the nature and the description of the event and the financial effect. And if it's not material, we simply leave it. So that's the decision-making flowchart. Thank you for listening, and I hope you now understand the two types of events after the reporting period.